Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. This video, I want to go through a put that I sold. Eventually got assigned, and I've been selling the cover calls against it for a few months. And this all started in August, so it's been a while. Company is CVS, and just yesterday, or recently, the other day, Amazon announced that they are gonna sell prescription drugs through the Amazon Prime service, and then companies like pharmacies like CVS and Walgreens got hit really bad. CVS is down from, it was at 73 or so, and it fell all the way down to 68. That's not great news if you're a CVS investor, but I'm selling the covered calls against it, and I'm kind of happy about this, and I kind of wanted to go a little bit lower, and I'll tell you why. First, though, if you're new to the channel, I'm Justin, and I like to talk about dividend investing, income from options, and financial independence, and document my own journey towards financial independence. So if you get any value out of this video, I'd really appreciate a thumbs up, and go ahead and subscribe to the channel if you haven't, because I'm putting out videos every Monday, Wednesday, and Friday. Actually, this will probably be out on a Thursday or something, but oh well. Story starts way back on August 12th when I initially sold my first put on CVS. Let's go ahead and look at the chart here. This is the big dip that they suffered recently on the 17th, but let's zoom out a little bit all the way back to August. Here we go. Here's our chart going way back to August. August 12th, right about here, I sold my first put on CVS, and it's trading at $64.88. And I sold for $62.50 strike price, and I got $102.48 in premium from that. Now, go a little forward, it was a monthly contract. So on 9/21, where are we at? All the way down here, trading at about $58, I got assigned. And got assigned, had to pay $62.50 for it, but I did have that initial premium to reduce my cost basis. Now this was too far below my cost basis of what that be, about $61.50, and I couldn't sell, anything by at that strike price. So I had to kind of just move it down to $60. I couldn't get any money for anything higher than $60. So I sold the $60 strike price on the 21st, monthly contract, and then I received $120 for that. Actually, I guess you would say $119.48 if we count fees and stuff. So around here, I wanted to roll the put. So I bought to close my original that I opened for $120, and I rolled it out for 1 month, and that cost me $74.51 to buy to close. So that initial put, or the initial covered call, it netted me $45.49. And my new put that expired in November, that got me $226. So now this expires out in November, third week in November, but on it'd be October 2nd, I got a dividend from CVS because I held it, and that was a $50 dividend. Actually, no, this was, I think the dividend was in November. I think the dividend was November 2nd or so. Then on the 3rd, I wanted to roll it some more. So I bought to close the October contract, the one that I got for I sold for $226, and I wanted to buy some time, or well, sell some more time. And I bought to close that for $204. And the reason I did this was because this was before the election and all the volatility and stuff was still really high. So this new contract got me $277, and now the new contract expires in December. So these are all the $6,000 strike prices. But after that, we had this big run in the market and it got up to $73. So this was completely going to get called away from me, and there's no way I could buy to close that for any reasonable thing. But I am profitable, and I did lower my cost basis, so this would be a profitable trade, even getting called away at $60. Then we had the big dip. Now we're trading at $67. I'm kind of hoping that this falls a little bit more, so I'd be able to maybe sell it and roll it for some more time, and get some more time value out of this, lower my cost basis a little bit more. Now we're talking about cost basis. That's going to be how we calculate if this is profitable or not. So we start out with our $62.50 strike price. So that's $6,250 that we have to spend on the shares. Then we sell the put for $102.48. That reduces our cost basis. We sell the first put for $120, but we buy to close that for $75 or so, giving us $44.97. We sell a second put for $225. We buy to close that for $203.51. That gives us $21.97. We get the dividend, which was $50, and then we sold the newest put for $277.48. All in all, that reduces our cost basis to $58.55. So even if these do get called away with that $60 strike price, I'm still profitable. $145. Not great, but it's still profit, and I'm still up on the position. If I would have not sold the covered calls, I could have, sold this way up here in the 68s or something and made a bunch more money. But I didn't know the shares were going to jump up like that after the election and the Pfizer news and the Moderna, the vaccine news. Common thing people say on the forums is that never sell a strike price below your cost basis. But sometimes I don't think you can really do that. And you don't know how long a stock is going to be in a downtrend or, just work sideways. So I chose to sell more covered calls to lower my cost basis faster. And that's how this worked. But now it's getting called away from me, most likely. And it'll be profitable. So that's what counts. All right, I think that's all I got for this video. Hope you learned something. Hope you get something out of the video. Go ahead. Give me a like. I'd really appreciate that. Subscribe to the channel if you haven't. And then I want you to go have a good day, all right? Justin out.